investors, merger acquisitions, all this kind of stuff. And I had kind of gotten away from my core passion and kind of what everything is that I'm focused on, and that's back into the world of crowdfunding. Of course, I have the other live stream I do with Eric that we just spent 2 weeks talking about Reggae Plus. But there's that's but I when I reconnected with Woody, who my guest is actually Sherwood, make it official, Sherwood, not Neiss. When I got reconnected with him, I was like, I can't believe we've been talking about having you on my show, and it hadn't happened, and that is we're way overdue on that. And for you that that had listened to the show on a regular basis, of course, the Compassionate Capitalist Show is all about creating wealth as an investor, as a successful entrepreneur. And we're going to go pretty deep, or try to, in the time that we have, talking about crowdfunding and raising capital from the crowd, direct public offerings. But the main thing I want to talk about as it relates to that, for those that are in my traditional kind of world of angel investment and venture capital, it's such a narrow gauntlet to be able to raise capital that way. And we literally have a fraction of the number of investors in angel investor communities and venture capital that we need to fund all of the companies that are eligible, ready, qualified for raising capital. And those particular channels completely, really almost do not exist, or are not a pathway for any form of a traditional consumer product, a lot of these different kind of companies that aren't necessarily tech companies. And that's the beauty of the different ways, and what's happened as a result of the crowdfunding platforms. It really is whatever flavor. It opens it up. You have this term in the industry called the great economic democratization of the capital markets, which is a tongue twister. And basically, what that means is that, all investors can play, all companies can play. Now, be doing it good it isn't natural. It's not something that you naturally know. You got to learn about how to do well at it, and that's why we do this. So let me tell you about Sherwood. He goes by Woody, and uh, I had known of him through the grapevine, but did not meet him for the first time in person until I went to a conference where we were both speaking at that crowdfunding and reggae, I think it was last year. And, turned out we were already connected on LinkedIn, but I had never had one of those conversations. And now we are, and here we are. So he is the principal of Crowdfund Capital Advisors LLC, a co-founder of the regulated investment crowdfunding movement. He literally practically lived on Capitol Hill trying to get the regulations to change to make it legal for entrepreneurs to raise capital from their customers, community, and the crowd, and removing and knocking down the ridiculous excuses that our elected representatives and the Security Exchange Commission made as to why they would not allow non-millionaires to invest in has been historically proven to be the best performing asset class for creating wealth. And I'm going to repeat that because very few people know this. That is one of the challenges that we're going to be talking about. But it is literally investing in entrepreneurs, when you know how to do it, is the best performing asset class for creating wealth. In fact, it is 3 times as profitable than real estate and stocks for comparable portfolio size. Because, hey, man, if Chat GPT and Google says that when you ask it, it must be true. Am I right?
Oh,
It's
absolutely.
yeah, right. So Woody is also the author of 2025 Investment Crowdfunding Annual Report. It's like a pitch book or Gartner for the crowdfunding industry. Also, he's going to tell us more about that, but he also does custom reports and subscriptions and all of that. You're going to hear more about in a bit. And I'm excited to talk with Woody about his new book, Investomers. Investomers. You see it in the title. There it is. He's got this picture. He's got his show in there. How customers turned investors are shaping the future of early stage finance. I haven't read it all because it is robust, It is as big and as detailed as my book, Inside Secrets to Angel Investing. And we're going to get all into that into the few minutes. But lastly, and this is the real cherry on top, Woody, Mr. Sherwood Neiss, has been named one of the top 10 most influential people in crowdfunding by Forbes magazine. Whew. And he's on my show. So we're going to talk about all of that and Woody's unique insights into the direction of crowdfunding. It's an info packed conversation. Don't leave until the end. So, welcome, Woody. Welcome to the Compassionate Capitalist Show.
Thank you, Karen. It is great to be here with you. I always enjoy your energy and enthusiasm, and clearly, we share a passion for entrepreneurship, innovation, and capital formation.
Yes, we do. Yes, we do. So, let's get started with this question. So, what are you passionate about? What did you wake up and say, I'm so excited this or that is happening or is about to happen, besides being a guest on the Compassionate Capitalist show, of course.
I
But,
mean,
you
well, that's how I woke up this morning. So,
know.
is there anything else? Um, just like in general, what am I excited about or passionate about?
Yeah, like what is it like you go, God, this is happening.
I mean, it's this entire movement. I people joke around with me, as for as much as we've done, I haven't made a fortune off of it.
Sure.
And the people that know me closely and follow me go, "You are one of the most hardest working, underpaid people we've ever met."
I
Um,
don't I don't know. I might be second running on that one then
well,
too.
so you and I are going to start our own club after this.
Yeah, yeah.
But it's when you have a passion for something, money isn't necessarily the primary motive or driver. And to be part of this industry and really help get it off the ground, I have two kids. I love them dearly. This is like a third child to me, and I want to help it grow. I want to help it succeed. I want people to know about it. And so that's why I get up in the morning, and that's why I work on all this, because I feel like this is fundamentally we are at a pivotal moment in history, and everything's changed, and this is the future. And if no one else is going to get out there and talk about it the way I am, then I'll step up and do it.
Yeah.
So
All right, very good, very good. So, let's I want to read this excerpt from your book because I really I think it sets the stage really well to talk about, because every time, I mean, I know for me, when I decided to write my book and really become a true advocate for crowdfunding, because I had, in my own experience, I had seen the frustration of innovation not getting to, running my angel investor group, seeing the limits that a small amount of people can do when they may love three companies, but the group only has money for one. And it's
right,
not that the other two aren't good or can't be successful. It just happens to be that one was the one. And it's such a challenge in the traditional pathways for good companies to get access to the capital. And I knew that the inability to reach out beyond the people in the room was a true hindrance for raising capital. So when the Jobs Act was coming about, it completely shifted my priorities of what I was going to do. And I had always known that it was a challenge for people to learn how to be an angel investor. When I first started meeting angel investors, and I'd ask them, how did you become an angel investor? And they would say, oh, well, I got invited and I lost money on my first three deals. And then I, started to figure it out. And I was like, well, that's a really horrible way how to learn how to be an angel investor, because you got to have some real fortitude to and angel investors, as angel investors, on average, putting 25K into something. So if
hmm
you're losing 100K before you figure it out, that's a hard lesson. You know what I mean? It's got to be a better way. So I'd had some things that I'd done, but it was really that pivot of the Jobs Act. My real fear that the Jobs Act would stumble and be, because a lot in the world of angel investing and financial planners and wealth managers, they always said angel investing was gambling and don't do it, right? And so I was like, you can do it, and I didn't want people that were invest on a video, I wanted them to learn the proper process to evaluate a deal, make a strategy of how you're going to invest. And that was the book, and my book. And my passion for that was realizing when my dad started to do the things that he was most passionate about, and I was at about that same age, and I was like, well, if not me, then who, right? So I think understanding this like concept, and I've evolved from compassionate capitalist to compassionalist, right? Trying to get
Mhm.
it down so it's not a tongue twister. So I love Investomers. That is such a great term. I hope hopefully you've got that copyrighted as a term itself, right? Or trademarked. But I'm going to
Mhm.
read a little segment because I think it sets the stage for because when I you and I first had our conversation, I was like, how did you become part of this whole thing? And you were not a lobbyist, you are not a politician, you are not any of those things that you would traditionally think of when you are going to go make a change on Capitol Hill. And for you to have put that all of that heart and soul into making this change that has really transformed, it is the economic democratization of the capital markets. I think it's such an inspiring story, and so I want to use your book as a way to let you talk about that. Okay.
Great.
Okay, so here in this introduction in the book, it starts out really, it's like a cliffhanger. The phone rang again, and it wasn't the first time we received a call like this. In fact, calls like this one came in almost every week. On the other end of the line was a relieved parent who had just discovered Flavor X. The situation was always similar. Their child had been struggling to take the medicine that they needed, often making every dose a battle. But after visiting the pharmacy or having their child's favorite flavor added to the medication, the struggle disappeared. Suddenly, the child was taking the medicine easily, avoiding extra doctor visits, and the parent was spared the stress of trying to convince their child to swallow something that they hated. This time, the mother's voice on the phone was filled with excitement. My kid just took the medicine. We've been fighting with her for months, and now you've solved the problem. I can't tell you how much that means to us, and how can I invest in your business? Da, 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 da. I was thrilled to hear yet another positive testimony about Flavor X, but my response was the same as it always was. Thank you so very much. But right now, Flavor X is still a private company. Still, her words echoed in my mind long after the call ended, and it got me thinking, what if our customers, the people who already loved what we do, could actually invest in the business? These were people who had already seen firsthand how FlavorX could improve their lives, and if they could become investors, they'd likely become even more passionate advocates for our company. They tell their friends and family about FlavorX not just because they had a great experience, because they also had a personal stake in our success. They'd be invested in our future, literally and figuratively, and their enthusiasm could help us grow faster than we ever could on our own. And they get rich as the founder gets rich too, right? Not near as much as founders. It's the greatest way to create wealth. But the big secret, because every company that just like favorite, like all these companies that get sold and go public, they almost always had angel investors, some kind of capital that fueled that growth until that point in time. And those people ride that wave of wealth creation. And but people just didn't know about it because what? It was a secret because why? It was illegal. So now, Woody, tell us when because you sold Flavor X. So
Mhm.
what was that? You had this inspiration. Tell us how that whole thing happened and how it started for you to and tell the story of Flavor X, how it got started to go out there
Okay.
and change the world.
Sure. So FlavorX, its inception really came from my niece Hadley, who, when she was born, had a bilateral brain hemorrhage on her fourth day of life, and so they were giving her medicine, but they mixed her medicine up with the medicine for another child in the NICU, and that sent her into seizures, and she's never been the same. She's in a wheelchair to this day.
Oh,
She's 33 now, so it's been quite a bit of time since then. But it left my sister and brother-in-law with a daughter that had a disability, for which they needed to give her medicine to treat it so that she couldn't have seizures. And phenobarbital was the medicine at the time. Of course, an infant's not going to say, I'm sorry, that's disgusting. I'm not going to eat it or take it. But she would just spit it out or vomit because it was so bitter and gross. My brother in law was a pharmacist by training. His father had a pharmacy. My sister said, listen, is there anything you can do at the pharmacy to flavor the medicine? He and his father sat down and they came up with a banana flavor that masked the bitter taste of the medicine, and she started to take it. And so what that meant was they weren't in the ER in the middle of the night. This was going on for years. They didn't have to wake their other daughter, my other niece, up in the middle of the night to go to the ER. So their lives resumed this normalcy. And so what Kenny and his father started to do is talk to the other customers in the pharmacy and say, listen, we've solved this problem. Maybe if you've got problems with other medicines, let's take a look at those. And so they came up with an entire formulary of medicines and it was like 42 flavors. It was like Baskin
Yeah.
Robbins for medicine.
I
Um,
remember that because my daughter, when she was young, they would ask, "What flavor do you want?" And I was like, "Flavor in the medicine? That's new." So yeah, that
yeah,
was you.
yeah. Yeah, so we grew it from one pharmacy to 40,000. I always told my brother-in-law, I was like, listen, we've got to learn to crawl, then walk, then run. If we want to have, and the whole goal, our entire goal with the company was make enough money so that we can take care of Hadley after we all die. And that was the vision that we put on the board when we hired every single employee. That's what we told them, and everyone was on board with that. And so I was just like, if we want to have a big exit, we're going to have to learn how to raise money. First, we raised money from the customers of Center Pharmacy, where we started the business. They were only from accredited investors, so wealthy individuals that were customers of the pharmacy. Then we did a round of financing with I actually went around the country, met with 3 different venture groups. Luckily, we were cash flow positive, so we were very attractive to everyone that we were speaking with. And I had them compete against each other for the best terms,
Nice.
the best valuation. We raised capital from Kane Anderson out in Los Angeles. They're now a 15 billion plus fund, or institution. And we grew it to 40,000 pharmacies, and we sold it to a private equity group. But the entire time, I was just like, I don't know. I sort of feel like if all those customers that were investors were along for the ride, they would have done like our biggest challenge was awareness. Nobody knew that we
Yeah.
existed. We didn't have tens of millions of dollars to
Right.
do advertising around the country when it came to cold and flu season. Get your kids medicine flavored. And I was just like, but one mother tells another mother, that whole philosophy resonated with me. And so we sold Flavor X, and we had the Great Recession in 2008. And by this, we sold Flavor X in 2007. In 2007 and 2008, I'm backpacking around the world. So I'm enjoying myself after, working very hard for almost a decade on Flavor X. And I'm watching what's happening. And I was just like, everyone's saying we need jobs. Like, this is the Great Recession. Everyone's lost their jobs. And I was like, I know how I can create lots of jobs. And I was like, we just need to change these securities laws to allow the average American to invest in startups and small businesses. Now, Flavor X was based right outside of DC. I actually lived in DC. My entire community of friends worked on the Hill.
Okay.
So I had relationships with people that were able to put me in touch with people on the Hill, even though I wasn't a lobbyist, even though I wasn't a lawyer. They're like, Woody, you've got a compelling story. Why don't you come in and start talking to these people? And then the most important person in the entire thing was Karen Kerrigan, who runs the Small Business and Entrepreneurship Council in Washington, D.C. She's like the closest thing I think small businesses have to a lobbyist in Washington, D.C. And she's always on the Hill, always advocating for startups and small businesses, whether it be tax relief, whether it be incentives. Just how does government policy affect these hyper growth type of businesses that our economy needs? And so they put me in front of all of these people. We testified in front of the House and the Senate. Our 8-point framework was turned into a bill in the House. It went through committee. It passed 407-17 in the House. President Obama came out with a statement of administrative support, literally saying, if you vote in favor of this, I will sign it. And in the Senate, that's when NASA, the National State Securities Administrators, came out to oppose what we were doing. It was all based on fear, uncertainty, and doubt. There was no data behind it. They're just like, grandma's going to lose all her savings. And I also didn't at the time have the data to disprove them. So we were both having these hypothetical conversations about, what is going to happen. Now I love getting up against anyone that has something negative to say about investment crowdfunding, because I just look at them and go, show me your data, because
Mhm.
I have all the data to disprove it.
Yeah, yes, you do.
Um, and boy, let me tell you, that shuts people up, because as soon as they know that I have all the data on every single offering and every company that's raised money and every company that's failed, I can run analysis on anything, on women and minorities, on different geography, on valuations in industries, and I can disprove anyone on what they're talking about. But I didn't know that at the time. They came out opposed to what we were doing. The people in the Senate didn't listen. It passed 73-26, and then we got to sit in the White House as the bill was signed into law.
Yeah, so what's so exciting about all of that, and when we had talked before, it resonates with me. Um, this common sense switch that says, now, there were two things. There was one where you like the aides to some of these elected officials, and you say, do you know that it's that you are not allowed to invest in these companies that are raising capital under the current laws? And they'd be like, what? And then the idea that we don't tell people, regardless of who they are, old granny, 18-year-old, don't go to Vegas and blow $10,000 or $20,000, or don't buy a lottery ticket of $100 a week or $500 a week. We don't put any limits on that stuff,
Mm-hmm.
except for except back then when it was to invest in entrepreneurs.
Right.
And I was like, yeah, what about that? And that was, and I know we've talked about this, and I joke in that it's not actually what was part of the motivation. I have surmised it from things that I've read. And so it's part of my storyline. So now I have to do a little bit of a caveat that says, well, I've not had this officially uh reviewed or vetted or whatever, but it seems like a lot of people get away with it. If you say it enough times, it becomes a truth these days. But
Right.
my thing was, uh they were looking at all of the collapse of the stock market and the real estate market as a result of the Great Recession. And they said, if millionaires invest this way, they can choose to invest any way they want. And the ones that know about it choose to put their money into private companies as an angel investor, or investing in a venture capital fund or whatever it is. They choose that because not because they want to lose their money, but because they know it's one of the greatest ways to create wealth.
Mm-hmm.
And so if you look at when we had reward based crowdfunding,
Right.
all the companies, I say, here's the stuff people don't realize: smart watches, 3D printers, drones, VR headsets, even the fidget widget. I love to show the fidget widget. They all came to market on reward based crowdfunding. And then years later, and I talk about this in my book, but that's why I guess I believe that this is why they did it. Years later, when those companies went on and got up $100 million or whatever, or sold their company, those people that had invested under or gave money for a product under reward base got nothing. Like the guy that Oculus headset, when it was sold to Oculus $800 million to Zuckerberg, those people, all they had was they paid $1,000 or whatever they paid for an obsolete headset.
Right.
Whereas had they been equity of $1,000 that then got bought for $800 million, usually crowdfunding is really tiny percentages, but still that might be 8,000
Right.
or 800, or we don't know because they didn't allow it back then.
Right.
So that to me was, why do we limit everybody, middle class people's ability to create wealth and jump the wealth gap? There is no reason to do that. And so I thank you for the effort and the time that you put in to making that a reality and giving economic democratization of the capital markets, which is really important right now. And this is my message I did on my live stream earlier about Reg A Plus. This whole thing going on with the stock market, right? If you were able to exit out before your stock, if your stock completely dropped, hold on till it goes back up, because that's the play that a lot of people are doing. But
Right.
if you did take money out, or if you're just like, this is too crazy, this is a great time to invest in come to the audience out there. This is a great time to invest in the company, be an investor, invest in the companies that you love, that you buy their products, that are raising capital, and you may not know that they're raising capital until you ask. And or the ones down the street, somebody that is a successful business that you go to on a regular basis and wants to franchise or open up a second location, or whatever that they're trying to do, just expand. We're trying to bring manufacturing back into the US. It's a great time to marry up your private capital with the SBA financing to help a business set up their manufacturing here in the US,
Hmm.
right? And I call it revenue share, getting revenue share out of it. So anyway, that's just got onto my hot box there. But you talked about data before and data analytics. Um, so let's talk about all these companies that have and all this data that you're gathering and how you get the data. So roll through, if you would. You've got CCA, Crowd
Hmm.
Capital Advisors. You've got Crowd Capital Ventures Fund. You've got Diversified Data Driven VCD3VC
VC,
AI, right?
and
You
Guard.
got AI, data driven insights for crowdfunding, the
Hmm.
crowdfunding market, tracking real time investment trends. Guard with an extra D, GUARDD.com, governance and compliance tools for digital assets, ensuring transparency and trust in investment platforms. And everybody, all of those links will be in the show notes. So you don't have to be like, what? And back up. But they're all in there. And they're also all on Woody's LinkedIn profile. So how do those work together?
Hmm.
Was it that you just said, oh, this isn't being done and we need to go figure out how to do that? Talk about the value that it is for the people in the audience that are listening, and they're whoever they might be, the entrepreneur, the investor, the
Sure.
economic organization.
So I started my career on Wall Street. I worked on the government trading desk for Payne Weber at the time. Now it's UBS, and we dealt in bonds. And I worked on the P&L for the floor. Learned a lot about Wall Street then. And when I went to Silicon Valley, I worked for a database company called PeopleSoft, and I was on their financial services side. So I met with CFOs from around the world and learned best practices on growing and scaling businesses. Now, PeopleSoft was a venture funded enterprise. And so I got to see what it was to be part of that. And then I started my own company that was venture funded, and I had a successful exit. When I left the White House after the bill signing ceremony, I went right to Bloomberg News. They had me on television that day. And I was interviewed as to what does this mean for our economy? What does this mean for startups? How's it going to work? So I went through that whole thing. And after the interview, the guy said to me, he's like, I know your background. I know you started on Wall Street. I saw you went to PeopleSoft. I know you started your own business. He goes, what role are you going to play? And I was like, well, we don't want to be a platform. We're still trying to figure it out. And he goes, why don't you just be the data provider? He's like, clearly, databases. You've experienced an exit, so you know what the signals look like for that. And he goes, and we buy data. He goes, data's gold. And I was
Mm-hmm.
just like, yeah, that's not a bad idea. Now, if you recall, the industry was signed into law in 2012, but it didn't go into effect until 2016. So I was
For
able
this is for Reg CF, but Reg
to
A Plus was before that, right? In five
regulate
and 16.
went into effect, I think, right away. Yeah,
Yeah, like
it
within a
might have been
year.
a year or so after.
Yeah, and then
Um,
and yeah, but all three, they took longer for the Reg CF because they were most concerned about that granny and people, really silly, but
no, that's
you know,
not it.
that's
Mary,
not it. Okay, what is it? Why was it did take so long?
Aaron,
There's a
here's
lot of
the
comment.
scoop. Are you ready?
Uh huh.
Mary Shapiro, who was the SEC chair, sent a letter to Congress, first time in history ever done by an SEC chair, before the bill was voted on, saying, do not vote in favor of this bill. Um, Never been heard before. Never has an SEC chair stepped out of the way to stop Congress from doing something.
Wow.
And she said, pass it. I'm not doing anything with it. And so we had to wait for her term to be over in order for this to come to, because the SEC chair determines what goes on her plate or his plate in order for rules to be made. Now, behind the scenes, all of the rules were made for this, from what I understand, from people that work in the commission or were working in the commission about 8 months after the president signed it into law. So everything was done, but she did not like this and she would not put it on her plate. And so it sat there. And we had to wait until she was gone in order for this to actually become, go live. That's
That's
the
some
inside.
power there, man.
Yeah. But
Okay.
it went live, and it's so. Let's just fast forward. So we built the database. We started collecting information on all these companies, and in the beginning, it was just an aggregator. We would talk to the platforms. Some of the platforms would send us data. If they were just doing one or two offerings, we would just pull in the information from Form C and the daily commitments, the number of checks. Just didn't make sense for us to set up a cron job, an API feed, or whatever. Um, but the database continued to grow and scale over time. And of course, the number of platforms coming into the space continued to grow over time. And I think there's over 150 platforms that have registered with the SEC to oversee these deals. And it got to the point where I was starting to do reporting on the industry. And so my first report on the industry was 8 pages long. There wasn't much to say. This one that you referred to for the 2025 annual State of the Industry report that came out in February was 210 pages long. So you can see there's a lot more for us to discuss. I'll just let the listeners know that anyone can download it. This year, we're giving it away for free thanks to a really
Yay.
nice donation that we got. But as the database grew, other people started to come to me. And the first group of people that came to me said, you wrote this law that allows for secondary trading of these securities after a 1 year holding period. Of course, with Reg A, they're immediately transferable once it's qualified by the SEC. However, secondary trading they're not covered securities. So it's not under federal exemption. You have to follow state securities laws at this point in order for those securities to be freely transferable. And you have to comply with what's known as those blue sky laws. There's one method in which you can comply with a lot of state blue sky laws, and it's called the manual exemption. And it states if you publish ongoing disclosures, sort of like a 10K or 10Q, like a public company does, into this regulated manual, the National Securities Manual, on an annual basis, then you can have coverage in the manual exemption. You can list your securities on these alternative trading systems and they can trade. So we built a technology platform off of the database because we collected all these data fields, but we needed to enrich it with more data fields to enable secondary trading. And so we built a database that has the fields necessary for the manual, and we launched Guard. So now companies, mainly Reg A, because there's not much activity we're seeing yet in the Reg A space, can come to Guard, publish their information there. We take in their audited reports, we run it through compliance. We then publish it in the National Securities Manual, and we give that report to an alternative trading system, and these securities can now trade freely. And so it's really, really opened up the door to secondary trading and liquidity. I'll tell you right now, we're trying to move these securities from the state level to the federal level. We're trying to make them covered securities and make it so that we just have the manual at the federal level, because you don't have to deal with the individual states. California, New York have their own forms that you need to be filed. So it's a little bit challenging.
Really? For
Yeah.
Reg A?
Yes. So little do you know, if even though you did a primary offering for Reg A and you might have filed Blue Sky for California, you have to file another form if you want to do secondary trading in California, and you have to pay a fee. And I think that fee is $1,100. If there's one thing state security regulators love, it's fees. and they've got fees for everything. So New York does have a form filing. If you did your blue sky filings for your initial Reg A, you don't have to do it again for your secondary. But with the manual, you're pretty much covered in the majority of states. California and New York are the only two that aren't in there, and there's five that actually just don't mention anything about secondary trading when it comes to securities, but they're very small states, so there might not be that much activity. But that was guard, and that's what we did there. Then with the database, and we started growing that, and we're like, it got to the point where financial service firms were reaching out to us and saying, how can we license the data? And then I started publishing reports, of course, the annual report. And then we said, people need to see insights as to what's going on. And so we launched C-Clear, which is crowdfunding clear. And it's to provide insights into the industry. So we have this free weekly tear sheet that shows, readers or followers, anyone can subscribe to it, it's free, on a week-to-week basis, what's happening in the industry in terms of capital commitments, checks written, industries that are hot, platforms that are, outperforming. Then we've got a biweekly report that really sort of digs into the data into 6 pages. And it's a deeper dive. So you can see trends over a 2-week period. And then we've got a monthly report. And what I like about the monthly report is we have a sector highlight. So, we thought initially it would just be software and technology companies on one end that would raise money. On the debt side, we thought it would be small retail type businesses. There are hundreds of industries that are represented in this data set. And so we started to do reports that cover restaurants, beverages, healthcare, life sciences, AI. And so every month we have an industry focus on that sector. And it's a breakout sector at the end of the report that does a deep dive into all the companies in that sector that have raised money, who the top 10 are, what their valuations are. And so we've learned a lot through that. And so C-Clear is our way to get information out there. The newest thing that we just launched through C-Clear is what we call the Offering Insight Report. So, if you're raising money through investment crowdfunding, you fill out this thing called a Form C. And it's the disclosure form that's required by the SEC, and it's published in Edgar. So we developed a tool that allows you to complete a very similar Form C, but we take in now your industry, your preferred valuation, and now we're doing comps. So we
Oh,
compare what you complete in your Form C to what every other company out there that has been successful with the Reg CF offering has performed. So you can see how much they raised. So you get an idea of how much you can raise. You get an idea of what their valuations have been, a range, and where yours is. So you can see, am I too high? Am I too low? Or is it right in the middle? And which platforms are the right platforms for you in this type of industry and deal. And that's 10 pages long. It's a very, very data. My fear is it's a little too data heavy because we break down even for women and minority founders that have been successful, how their offerings have performed. But it's a deep dive, and so that's like the data arm. So
and now on that one, excuse me, it says so subscribers would be the issuers that want to get a better idea before they start their capital raise on that, but also investors that might be looking for a certain type of sector or solution to see who's out there and how they compare to each other, or is it both?
absolutely, yes. So if you're thinking of excuse me, launching an offering, people will come to us and they'll complete the form, and then they'll be like, okay, now I know how much I can expect to raise. Now I know, what value. If you've no idea where to set your valuation, this will help you set your valuation. If you know you're going to be pushed back on your valuation from people in your comments thing, you can be like, we got the Offering Insight Report. Here's a copy of it. It shows you the comps for other companies in there, and we're right in there. Like we are right on target with where our valuation should be. That's what you as an entrepreneur need, because you can't just throw a dart at a board and say, this is my valuation. You need to have some sort of objective proof as to why your valuation is where it is, and be able to tell investors, this is why we priced it where it is. Investors, yeah, it's perfect for them. We actually have a separate product called Capital Pulse. And so the other product that we created was an algorithm. And we sat down with three data science PhDs. And I literally said to him, I was like, so here's the deal. We all know about AI and machine learning. I was just like, I've got hundreds of thousands, if not millions of rows when you look at the transactions on each offering of all these companies that have raised money. I personally had an exit. Like I know like what I believe are the signals for companies that are going to go on for a follow-on round of financing. I can't actually tell you which ones are going to have the exit, but I know like if I'm looking at a company, if they've got milestones, if they're hitting it, that they're most likely going to go on and be successful in a follow-on round. I was like, to me, those are the signals that you follow. And so we built an algorithm that prioritizes or ranks these companies based on the amount of capital flowing into it from investors, the number of checks that are being written, and then a lot of the same fields that VCs look at, like your cash delta, your net income delta, your revenue delta. We want to look at your short-term and long-term debt and see what kind of impact that's having. So we built this algorithm that then scores every single offering, and that's something that we actually push out there for investors. So here's the problem: if there's right now there's 650 active deals on a daily basis, 650 across all these platforms. If you're an investor and you want to invest in some of these companies, where do you even begin? Like it's impossible. But if you get the Capital Pulse report, then you have our top rankings of what the algorithm says are the companies that we think you should consider looking at. Not that you should make an investment, but it's just a guide for you to do your diligence. And so that's a report that people and investors can subscribe to there. But once we built that, I said, why don't we just start our own venture fund? Why don't we start investing off of these signals? And we all know that, and you started this entire conversation with early stage investment outperforms every other asset class. Okay. You didn't actually come up with that. I didn't come up with it either. But I'll tell you, there's some PhDs at MIT and Harvard that have written very detailed studies on how, when you invest in early stage venture funds, the ones that invest in the earliest stages far outperform those that are late stage venture funds or hyper growth venture funds. And so we took that philosophy of invest in early stage, which we are, investment crowdfunding. Most of these companies are at their seed or earliest stages, and the algorithm that has identified signals of companies that are most likely to go on for following round of financing. And then we formed a venture fund, D3VC.ai. It's an early stage venture fund. And our goal is to invest in 200 companies over the next 2 years. We're already well into investing. We've already diligenced over 200 companies. We've made 17 investments so far.
Wow.
But the goal is invest $25,000 or up to, I should say, $25,000 into each of these companies. And instead of a VC having one or two outliers, we think we're going to have 40 or 60.
Yeah, because you got the data. And the thing
Yes.
that you said is this is one of the things I teach on. And, it's so logical to actually think that there's a program that could figure this stuff out. There's a guy out in Texas that I have been talking with for a long time that has a really complicated way that he goes about trying to assess VCs investments and companies and all of the business plans and the this, that, and the other, and being able to calculate the odds of somebody's success. It has this really complicated thing, and I struggle to get my head around it and how he uses it and all that kind of stuff. And what you just explained was like so spot on, because one of the things that I teach, and in my upcoming book, Inside Secrets to Crowdfunding Investing, it's one of the biggest reasons why companies end up in this, what I call the Midland of angel investor groups and venture capital groups and any of those groups, right? There's the ones that they just fail for lots of different reasons. There's the three. And then they always talk about over here, the one that hits, 10X, 20X, that makes it up for all the others. And then you got your 4X, 5X, blah, 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 blah. And then there's these ones in the middle that just sort of, they raise their first round of capital and they kind of just plateau. They start growing organically. They get to a point they can't raise venture capital. They're too small for private equity funds. They need more money than a bank. The angels aren't going to put any more money in them, and they just sort of get stuck, which is where I think combinations of of crowdfunding, and particularly Reg A Plus, are a real tool for those kind of companies if they've got the underlying thing right. But the reason why they end up there, and the reason why the investors get frustrated, is because it's really easy for an entrepreneur to sort of drink the Kool-Aid, if you will, that says, "Oh, I'm going to raise $2 or $3 million, and then we're going to sell all this stuff, and we're going to make all this money, and that's all the money I'm going to need to raise because I'm going to have so much revenue, and I won't need to, and then I'm just going to be off to the races." And the reality is, I tell them when they show me this stuff, I go, "What's your next round going to be like? What's your cap table? You building your cap table?" I say, "So name a company to me for me that 100 million plus that had a successful exit that did it with $2 million."
Mm-hmm.
It doesn't
Right.
happen because
Right.
there's marketing expense. There's all this stuff that you have to invest in. Investors help you do that so that you can continue the growth. If you have to
Right.
take your cash flow and do it, then you start having to choose, right?
Right.
You can't do it all. So, to be able to look at those milestones and those metrics is for an investor to look, because they've done a seed round and now it's this next one, and you're able to look at that. Golly, that is like, that is priceless. American Express term, that is priceless. It's not
Yep.
priceless for you. You charge a price for it, but that is, that
Right.
is really gold to have those kind of insights. So I can see why your fund is going to be there, because you're providing the data along with, and there's also definitely an emotional element of it. There's the gut feel that you have over a time of between this company or that company that might have the same, you know, fundamentals that seem like they would both be successful, but you kind of, the coachability of the founder or their willingness to build teams, or, whatever their leadership stuff, there's lots of different things like that. So, um,
I,
now go ahead.
I have a huge vision with the fund too. Like we're trying to prove something with this, first fund, but I believe that if the signals all work, then JP Morgan, the US government, they need to carve out $1 billion fund at least. And we need to follow these signals to start investing in. It's not that I want to invest in these companies, I want to invest in our future unicorns. And
Yes.
they are in this data set because
Yes.
the healthcare companies that are in there are fascinating. Fascinating. The software technology companies that are working on AI, and there's so much different AI happening, are fascinating. And so I don't know who's going to be the winner, but I know within this data set there will be many. And I feel like if we can prove it's working with $1 billion fund, we're going to find those companies, we're going to invest in them, and there's going to be a lot more people that get wealthy because of it.
Yes, and this is a thing that a while back I did a little live stream trying to show the value of the money at the government at the time, because of SBIR, they call it the America's Venture Fund or something like that, and how many
Mhm.
startups there were and how much money was going in. And I said, here's where, and I use this example, it was like baking soda and Sprite or something, right? That makes it bubble up, right? And I said, here's the thing that you have to understand: when money goes into businesses to facilitate growth, right? Whether it's equity or debt, whichever way, but when money is available to go in there and they start bubbling up, it is what fuels the economy.
Yeah.
It is what creates the jobs, well-paying jobs, and those people can go out and buy other stuff. And as those businesses start to grow, they have to buy other stuff from other business services and products, and it creates the cycle of growth. That is why I have really, really lynched onto this idea of economic resilience with
Hmm.
community-based financing. These are terms that you and I use, right? In our space, but I'll talk to people just like talking to people like, "Oh, have you heard of angel investing?" And they don't know. They never know what angel investing is. And that's because of the myth for so long about it being so risky. And then I have my theory on that as well that I use a lot. But it is where particularly different sectors of our community that have been traditionally kind of left out of the capital conversations, right?
Hmm.
People of color, women, they, certain sectors of, sometimes it's like, I want to just say millennials in a big group, but there are sectors of age and innovation and stuff like that that makes it sometimes it's harder for them because they just don't have the experience, right?
And
And
geography.
geography, very much so on geography. And so that they this is a way for them to get access to capital. But we that are trying to figure out how do we can't invest in real estate. Real estate's gotten too expensive. Crypto is who knows, and the stock market's like all over the place. But what you do know, if there's a business that you're in the chamber, and this company that's in the chamber with you is raising capital. What you do know is there's a gap between what they need, even on purchase order financing, that you might be able to do short term flips on your money. There's so many ways that investors can participate in community based finance. Like when we look at those crowdfunding companies like Honeycomb and SMBX, that's a fixed term loan where they can't get it from a bank. They're still doing it from their customers. You know what I mean? They're
Yep.
still doing it like that. It's still using all of those platforms, but there's just so many ways for the people in the community to participate in the success of the businesses in their community, whether they're startup or growth, that creates the jobs, fuels the economy. And it's the message that every time I can have anybody listen to it, to be like, you can do this too. And you're
Mhm.
providing it with the Investomer. When I get it, my compassionalist stuff up, we're two of the people in the marketplace that are trying to solve the problem. And so I'm really, I'm happy that we're doing that, and we're having an impact. And so that leads to my question as we get ready to wrap up here. So I know it sounds like you're enthusiastic that we are finally have moved our has the pendulum swung? Are we in a steady growth? Are we still, because the SEC and the Treasury did reports at the beginning of last year that the reason why we don't have enough capital for entrepreneurs is because of lack of awareness, education, and tools. I said, there's the trifecta. That's what I got. You've got it. So is it getting out there enough that we can start to see a swell? Or are we still really at the infancy? You birthed it. Where are we?
Yeah, I mean, if this were a baseball game, I'd say we're in inning two. I wish we were further along. I feel like the media, the general media coverage, your NBCs, your CNBCs, they have not covered this industry the way they should. Fox Business, barely. And they all need to be covering it in a way that it has been covered so that more people understand that this opportunity is out there. I think that, I'm going to sort of poke the bear here. Um, I, I think VC as we know it it's not dead, but it's never going to come back to where it was. And if it's not going to come back to where it was, and people need to get on board with the fact that if it's not coming back, we need to figure out what the alternatives are. So you got angels and you got investment crowdfunding to fill the void. That VCs are going to move upstream. They're going to move to where private equity is because it's just it's a lot less risky. And so we're at this stage right now where I think we will see the groundswell happening because ideas don't disappear. We're not doing
Yeah.
anything to stop ideas from happening. Where there's ideas, there are businesses. Once there's businesses, there's a need for capital. So the need for capital is not disappearing. People will be searching for solutions. We've all seen how the internet, technology, our phones, social media has changed the way we live our lives. Investment crowdfunding is a fundamental shift in the way companies are funded. And this is going to increase in awareness, and more companies are just by default going to begin their fundraising journey through investment crowdfunding. And I think that's where we're headed, and that's where it's going to be.
Yeah, I think so. I think the thing that I think happened with VCs, and maybe I saw, because the fact that I ran my angel group before the Great Recession, right? And then, the role of VCs and all of the talk. Oh, dry powder. Are you making new investments? What's going on? That was going on around that time. And then where we are now, I think there was this sort of like an explosion of VCs in the last several years, let's say 4 or 5 years. And it was like there was no barrier for somebody saying they were a VC and starting up a VC fund. I would
Right.
have people come to me and be like, "Oh, I want to raise capital for this VC fund," and I'm like, "Well, what have you done? Like, why would somebody give you their money?" You
Right.
know, and I interviewed a while back a guy that, so this is the difference. Used to be VCs were like you had to know someone who knew someone or to like do anything. And now there's this guy out there marketing, selling marketing services to VCs so they can go out and market to get more companies and investors and all that kind of stuff, which at the surface level is kind of nice, but it's like, that they're more open, but I think it was by necessity because there was too many of them
Right.
and they weren't. And so the ones that had the ability to discern, that can
Mhm.
produce the returns, that understand market trends and when's a good time to get in sectors and out of sectors and things like that, they will survive. The newbies that did one round, and there's a lot that didn't put their money to work. Like, why would you didn't put my money to work? I want my money back. So that's happening,
Yeah, exactly.
right? And it's like, so what we've got to, I think what's gonna, it's a writing of this rebalancing of it. And some of those that were what we call boutique funds will go downstream into being funds for crowdfunding or
Hmm.
like Reg A plus. So instead of, they might have to take on a different name, I don't know, right? And then the big boys will continue to do the bigger stuff, but they probably will go up, depending on how valuations get reset. I've seen them go up and down the food chain depending on the values and the valuations and what they can think. And there's definitely going to be a quiet period for at least another year or two till other things stabilize in the economy. But when it comes to big venture capital, and I see a lot, some venture capital companies, I saw notes that they were buying back shares from some of the earlier investors to take off the pressure of going public
Hmm.
and giving them more time to become the true unicorn that could perform on a public market. So,
Right.
there's a lot to watch in that space. I think you're totally right on the crowdfunding side. So, what have we not talked about that you want to close with? Probably could have closed on that other, but I had to throw my 2 cents worth in about venture capital. So, because you really do have your finger on the pulse. We don't have a Fran Tarkington standing out there on a Super Bowl ad saying, go get into crowdfunding, right? So word of mouth is always a challenge. And I say to the audience, please share this video, this podcast with it all over your social media. Help us build the awareness and overcome the deep secrecy that angel investing has been for the 80 years that it was illegal for the average person to get involved in it and companies to even talk about raising capital. And let's bring the light of day onto this. What you got, Woody?
I'll just end with where this industry is going to be in a couple of years. So we all probably scroll through TikTok and Instagram and Facebook Reels, and that's how we spend our free time. What's going to come next is what I'm coining as influvestors. So we've got uh, investomers, which are customers that are investors, and now we're going to have influvestors, which are influencers that are investors in these companies. So it's not just the customers that become the investors. Now they're going to be leveraging social media, and they're going to be like, guys, get this. I just invested in the coolest healthcare technology company that's leveraging AI to find out which diseases, which cancers can be cured in faster, or which drugs will work in cancer treatment. And they're going to be like, I'm an investor in it. I'm not getting paid by them. I just want you to know that it's super cool, and you can find out more about them by going to XYZ funding platform / company name. Um,
Yeah.
that you're going to see happening a lot more, and it's going to be in your social media feed, and it's going to fundamentally shift this whole industry as well,
Yeah.
because we've seen how these millennials live their lives. They're This is how they're going to be investing.
I think it's
So
true.
get on board.
Yeah, we saw sort of like as Ashton
Kushner. Yeah.
got involved in angel investing, and all of a sudden it elevated the profile of that even at the time, right? When he started
Totally.
doing it and some of these things. So I do have to uh, ask one last question.
Yeah.
So your fund, can anybody participate in that?
I wish they could. The laws regarding venture funds are still the same laws as they were, with the exception of it's a 506c fund, which means we can do advertising for it, but we can only raise money from accredited investors.
Okay.
So I have lots of friends and family that are believing in, that have known me for the better part of a decade. I've actually been working on this since 2010. So yeah, we're a long bit into it, 15 years. And they're like, Woody, I trust you. Like, let me ride with you. Anyone can go to d3vc.ai. We post all the investments that we've made. I have letters to our LPs, so you can read those there. But I'd love it if more people reached out to us and got on board with us.
Yeah, absolutely. I think so. Hopefully, there people you heard that everybody. There's your call to action. Go check out those websites, and then when you're ready, if you haven't yet started investing in private companies, I've got the course, the book. You can come and learn how to do that. A person was talking to me the other day. Go, I don't want to do a course. I just want help in figuring out which ones. So there's a combination of my discernment and your data, and we're the dynamic duo.
Yeah, let's do it.
All right. Thank you, everybody, for listening. Woody, thank you for being a guest on the Compassionate Capitalist Show. Onwards and upwards, everyone.
Thanks, Karen. Bye, everyone.
Okay. That was fun.
Yeah. All right. I was doing the upload.
Oh,